Today is about the most exciting topic for every single person out there: international investing and emerging markets, and why we should care about them again. And look, I get it. If you look at the charts, the last 15 years, these two markets have done nothing for you. But you need to pull that chart back longer. You need to look at some of this historical context, and you need to be thinking about, is there a regime change happening? Is 2025 a tipping point where all of a sudden, other than the last 14 years, the US markets stop completely outperforming their peers in emerging markets and in international markets? And now if you go back and you start looking around the year 2000, from 2000 to 2010, U.S. markets actually lagged their international emerging markets peers. Emerging markets beat U.S. markets 9 out of 11 years. We're up about 150%. And international markets beat the U.S. markets 7 out of 11 years. We're up about 30%. So you had that decade run. And what was driving that? If you think about what the world looked like, we were in peak globalization. Starbucks was putting a Starbucks on every corner. People were discovering the iPhone. China was opening up. China had this major boom. Investment was going into China. We were expanding everywhere. We were developing concepts, and we had all of these new markets open to us. And so suddenly those markets were growing significantly faster than the US. The US was also facing some significant challenges. We had the tech bubble that hit a lot of companies here hard. We unfortunately had 9/11, which was extremely devastating. And then we hit 2008 and the financial crisis. And we see 08, 09 as the tipping point. And ever since then, the US markets have vastly outperformed their peers. We're talking 12 out of 14 years, US has beat emerging markets, including China. And especially if you look at international markets, Europe, the UK, Japan really haven't done much for investors. But we're starting to talk about the need to be investing in these markets, not just to help protect you from currency fluctuations, because those markets are catching up. Technology is a great equalizer. Look at Southeast Asia. All of those are major innovation points. We're not the only ones working on AI. We're not the only ones building chips. You now have some very significant companies based overseas. And for the first time in 15 years, we're strongly saying investors really need to consider looking at more international investments. And I know it's a bit counterintuitive, but you need to look back further, and you need to be thinking about what's coming down the pipeline, not what happened the last decade. Because while history rhymes, it doesn't necessarily repeat. And we need to be looking and seeing what's the next phase of this investing cycle. And what's going to drive that? It's going to be AI. It's going to be innovation, but it's other things: economic cycle, natural resources, country-specific events may affect this. And especially right now with the US dollar under a little bit of pressure, we want to make sure we're looking a little bit broader. We want to make sure we're hedging our bets a little bit. I am very pro-US. That's not changing. I'm just saying everybody needs to be considering adding in a little other exposure, because we could see Europe suddenly start to outperform us, and those companies over there are cheap. Not a whole lot here that's cheap in the US markets in the large cap space. So look at the charts, take the charts back a little bit further, and realize and consider, are we at a point? Is this a tipping point and another regime change where it makes a lot more sense to be more diversified, not just solely in the US?